I'm Spencer Cole. I'm the Chief Investment Officer of Vox Royalty Corp. Vox is a returns-focused mining royalty investment group listed on the NASDAQ and TSX main board. We were set up 10 years ago, and our North Star is delivering the highest return on invested capital in the entire $70 billion mining royalty industry. We're precious metals weighted and weighted to safe jurisdictions such as Australia, US, and Canada.
Good to see you again, Spencer. It's been a while. I think we with Kyle back in March. Let's talk about the royalty market, because it's not a particularly big market, but there seems to be a lot of heavily weighted towards the kind of smaller companies. So again, lots of people trying to imitate the kind of the weakness of this world, but maybe not managing to do so. For you guys, it's a kind of slow, steady, accretive growth is the mantra. I know that, but you've still got to tell a growth story. So what are the things that new investors to the Vox story need to understand?
Yeah, absolutely, Matt. Pleasure to be back. I think what we sort of generally communicate with new investors is Vox, yes, is one of 30 listed royalty companies, but over the last 10 years, it's been built quite deliberately to serve a specific type of need in the market, even within our sort of 30 royalty companies subsector. We, from day one, have been focused on return on risk-adjusted return on invested capital.
What's that mean?
Yeah, so we choose each of those words carefully. I mean, return on capital is pretty straightforward, but there's a lot of sort of capital allocated in the mining industry in a very sort of risky fashion. So when we say risk-adjusted returns, we truly mean what's the revenue we're going to get out of these royalties, and then adjusted per unit of risk we're taking on.
Okay, but again, explain that. When others do it in a risky way, you're saying, and we don't. So what are others doing incorrectly, and what are you doing right?
So the two most common sources of risk that are mispriced, to the detriment of generalist investors we find in this industry, in the mining industry. One is country risk. So, for example, chasing, gold revenue from Mali or Burkina Faso, for example, or secondly, mispricing technical mining risk. So, going extremely deep underground or making hopeful assumptions in your feasibility study, and everything needs to go right for the operator and then by extension, the royalty company to make more than 15% on their money. So we constantly see those two risks mispriced, and ultimately generalist investors, if they don't have the right management team protecting their capital, they're the ones left holding the bag with that mispricing of risk.
Right, but you also got to get the balance between being overly cautious and intelligent allocation of capital, right? So because what we've seen, I think, a lot in this space is juniors receiving multiples on the good assets and the bad assets in terms of their allocation of capital. And sometimes, if you're doing things as you are, you might think, well, that's slightly unfair. People are being credited for stuff which is actually hugely risky. So you've not been tempted at all to maybe kind of mix up the portfolio?
Oh, look, I mean, we constantly have a vigorous debate internally about different investments. And, we have stepped outside of our sort of Australian and US focus occasionally. We bought a gold royalty in Nigeria, which, it's not everyone's cup of tea investing in Nigeria, but within the space of 3 years, we were able to make 5x our investment on that. And it was fundamentally a small position within our overall royalty portfolio. So we do selectively go outside of sort of OECD type countries, but we need to see the right return profile, to take on that type of country risk.
I said, okay, let's drill down into that one. So Nigeria, as you say, people, perceptions of Nigeria. I've worked in the oil and gas business and gold. So I understand it a little bit more, but only because I spent a lot of time there. But for people looking in, they may say to you, well, why on earth go for Nigeria? What was it about that particular opportunity which you thought, well, actually, no, this is going to be okay?
Yeah, so to be absolutely clear, like 80% of our portfolio still is weighted towards Australia, US, and Canada. But in that specific investment, it was a Vancouver-based mining company, listed on the TSX Venture. The royalty contract itself, if there were any issues, it would have been ultimately gone through the British Columbia court system. So there was another sort of contractual level of protection there. And for, at the time, what was about a sub 5%, of our total balance sheet being invested, we projected a return profile that was very healthy, double digits. And so, I think for any investor, the prospect of making 5x their money in 3 years is pretty attractive, particularly for a small position like that. So, it's particularly given that as the first commercial mining, like gold mining operation in country, there was a whole host of challenges the operator successfully navigated.
Well, yeah, 5 times your money in hindsight is great. It's at the time, I guess it's a big bold step. Look, well, let's talk about some of the other things that you do that perhaps others don't. You're very much focused on near-term revenue within 2-3 years. That's that time frame. Is that right?
Yeah, absolutely, Matt. So we're looking for assets that have been incredibly de-risked, that have large-scale operators, ideally majors, operating them, where ideally the mill or the processing plant is already built, and it's just the question of when that royalty-linked deposit is going to be mined. So our sweet spot is anywhere from 6 months to sort of, call it 3 years from first production.
Okay, right. So what I'm hearing is the message of, if you are a cautious investor, if you sort of treat your money with a bit of respect, then maybe this is the type of investing for you. This Vox company is the company for you. That said, I would also like to see some scaling quicker, and I think you've done this a couple of times now, and more recently with this Australian royalty portfolio that you've picked up. Tell us a bit about that, because that moves things forward at a pace, doesn't it?
Yeah, absolutely. So for listeners that aren't aware, we recently closed on a portfolio of Australian gold royalties with a little bit of copper exposure as well. What really attracted us to that deal, Matt, was the key asset, which is called Castle Hill. That's in construction at the moment, and it's being built by one of the top 3 gold producers in Australia, Evolution Mining. So expanding our sort of exposure to the top 3 gold miners in Australia. We expect that to come into production in early 2026 and add sort of immediate revenue that should largely drop to the bottom line. But a lot of our focus is on Western Australia, as you know, and we continue to see just significant amounts of money being invested in the ground there. And so this is right down the middle for us. Castle Hill is just outside of Kalgoorlie. Abundant labour force, well-capitalised operator. We think the resource has ultimately got potential to be expanded, and first production in early 2026. So this was right down the middle for us. And I think the other aspect to this deal is the way we model the returns on this asset, on this portfolio. We essentially get paid back just on the Castle Hill assets, and then the other sort of 3 royalties we essentially over time will get for free, we expect. So, we get copper exposure, even some rare earths exposure, effectively as a tag along when this Castle Hill royalty, pays off the entire deal in the first couple of years.
Right, okay. And if we sort of look at the portfolio as a whole, you had a good year last year, up 45% on the year before in terms of annual revenue, good, and good margins, as one would expect. How are you treating the capital? How are you treating this money that's coming in? Again, coming back to this growth story, you've always got to be telling your growth story. You're a dividend payer now, which is nice. But what are the ways that you feel you need to allocate capital to kind of maybe start getting the recognition after what's been a tough few years for precious metals?
Yeah, so it's an interesting question. We tripled revenue in the last 3 years, and obviously that creates a bit of a rod for our own back. Tripling revenue is always challenging, but that's, the goal is to continue delivering, both revenue and free cash flow growth per share. I think one thing that has held us back, and this might sound a bit strange, is our exposure to Australian royalty assets and ASX listed operators. I think a lot of the street views some of our Australian assets with some suspicion until they start, generating cash flow. So if you look at how brokers value Vox, most brokers value between 10 to 20 royalties out of a portfolio of 70. And so, we've had numerous instances where a royalty started paying and brokers previously haven't even attributed any value to it. So I think this disconnect around getting a discount for our Australian portfolio is something that we need to continue educating the market around. I think as free cash flow and revenues continue to grow from our Australian royalties, I think some of that skepticism or the discount will continue to erode. But I think, we still see that as being part of the opportunity here for future investors, is that a North American listed royalty company that's heavily weighted to Australia, investors are sort of somewhat dislocated.
I can't even wrap my head around that thought process. But in terms of Fraser Institute or however you want to view it, Western Australia, it has lots of very, very strong gold producing companies, and it is a good place to do business. And the ounces that come out of the ground are as good as the ounces anywhere else. So where does this where does this come from? Why is there this disbelief or disconnect with developers in Western Australia?
A recent example, Matt. 2 weeks ago, I was in a meeting with a Toronto-based generalist fund. They managed $3-4 billion, and they said, who's this Northern Star Resources company? Can you explain who this major operator is that operates a handful of your royalties? I said, well, they produce 1.6 million ounces of gold. They're a $15 billion company. They're Australia's largest gold producer. So, but when you're having to explain, multi-billion dollar ASX listed gold miners and operators to very large generalist funds, that's part of the challenge, but part of the opportunity for new investors is there's this lack of awareness around some of the large operators in Western Australia, particularly in North American capital markets.
But I think, and that's a good example actually, but with generalists, they're going to be looking at you, I guess, very differently. They're going to be looking at you as a revenue generator, trying to understand, what your PE ratios look like and, your ability to continue to drive revenue. That's what you're going to be judged on, not necessarily wanting to get into the weeds with regards to the ability of your the royalty holder, the companies that you're working with, to get stuff out of the ground, because they don't understand natural resources. They haven't been in natural resources for such a long time, and understandably so, because it's destroyed a lot of value. So finding ways to kind of get the generalists back in there that's pretty exciting. So is this a recent phenomenon?
Yeah, I'd say the major catalyst for us, Matt, was our NASDAQ listing. And, we listed on NASDAQ about 18 months ago, but really it's only the last 6 months that we've really started to see volume tick up. And, to be perfectly frank, most of our sort of investor outreach and marketing has been heavily US centric in the last 6 to 12 months. We're spending a lot of time in places like Boston, LA, San Fran, where you've got these huge pools of generalist capital, family offices and generalist funds, long-only funds, who are trying to cycle out of tech names. They've made spectacular returns on the NVIDIAs of the world, and they're looking at the macro environment in the US and saying, I've got no exposure to hard mined commodities, but I don't trust mining companies. So how do I get, a sort of leverage play on commodities where I can trust the management team? So those meetings with generalist investors in those cities have been enormously productive, and that's what's been driving sort of increases in our volume particularly on the NASDAQ in recent sort of months and quarters. So
right. And what's that do for you in terms of that changing or evolving of the register, in terms of your ability to get access to additional capital when you need it? I mean, you obviously, I think when I talked to Carl earlier in the year, that he'd just got a $25 million facility in place. More money means ability to do more deals, doesn't it? How does the register help?
Look, the register sort of, obviously the supply demand fundamentals of the stock speak to the share price, but I think we are in a position now where we're generating free cash flow. We have the $25 million undrawn credit facility from BMO. That credit facility more than halved our cost of capital. I'd tell you, if any small to mid cap royalty company, their equity cost of capital, particularly at a smaller size, is a healthy 20% plus, mid 20s. So for us to have sort of circa 8.4% cost of debt now, that's a game changer for us. Because we own 10% of the company as management, and then including the board, it's closer to 20%. We don't want any further equity dilution. So the North Star for us is trying to reuse the credit facility as much as possible, so that we can scale accretively without bloating our share count. We still only have sort of 50 million shares out, and we'd love for that to be sort of the end goal ultimately. So now some royalty holders and prospectors that sell us royalties agitate to take our paper because they see the benefit of going from owning one royalty to getting exposure to 70 royalties with our paper. So I'm not standing here saying that we'll never issue another share, but we certainly want, our goal is to focus on per share returns and per share free cash flow growth. That sort of continues to be our focus.
Right. Okay. Even though you're only getting credit or value for 20 out of 70 assets in the portfolio.
Yeah, look, it is frustrating, but I think because the majority of our capital is focused on those assets that are, within 2 years of first production, we have the benefit of, if the market's not giving us full value today, either wait a couple of quarters and they're producing revenue, or selectively we will look to opportunistically sell assets, to try and bring some of that value forward, which we've done once before. So we are in some exploratory discussions with a few groups. That's not to say anything will materialize there, but we're not kingdom builders at any given time. Everything's for sale at the right price as long as it compensates our investors, fairly. So
okay, and just tell us in terms of trying to get more value attributed for the 50 or so which are not, and they'll obviously be, you publish the information, but varying degrees of advancement, etc., and varying degrees of risk and varying degrees of size and scale of revenue opportunity for sure. But in terms of maybe trying to make it, getting credit for 30 of those 70 rather than 20 of those 70, do you think that is just purely down to, well, once they start producing, it'll be fine, we'll get some future value for that? Or is there anything that you can do now in terms of continuing to tell a story to these generalists or to the brokers? And if so, what is it? What is the big message to those guys and say, look, we should be credited for this now. Here's what you need to know.
Yeah. So, we're constantly looking for better ways to communicate value to our investors. I think one thing that's been really helpful in the last couple of months has been 2 extra brokers have initiated research coverage on us. So, and most recently in the last month, there was a small group out of the US Freedom Capital Markets that initiated on us. So getting more coverage in the US, I think, is particularly helpful from that perspective. Going back to your question, yeah, I mean, we can either wait to harvest cash flow as these assets come online. We could opportunistically sell non-core assets, or we could just communicate the embedded value of those more effectively. I think the challenge we face with a lot of generalist investors is no one's got time to value 70 royalties, and we don't expect anyone should. People are looking for rules of thumb to come to value as quickly as possible. And within our portfolio, there's been a few assets that have really been accelerating materially, like assets like our Red Hill Gold royalty, where some brokers believe, that speaks for anywhere from 50 to 80% of our sort of market value currently. So, there's a few assets that have emerged as cornerstone assets, but they've grown from very modest purchase prices into organically growing into assets that are now cornerstone assets. So I think as that evolves, as, people can get to value by modeling fewer assets, I think that's also helpful, Matt, just for investors to start moving into the stock as well.
Great. Okay. And talk about the rest of this year. Obviously, it's been a good start to this year. The stocks, really moving. What else are we going to see and expect from you?
Yeah, so we've got a few more deals that we're working on at the moment. So some royalty portfolios and some individual assets. So we're cautiously optimistic that in the next couple of months we'll be able to announce a few more acquisitions that, same return type focus, same commodity suite that we've historically transacted on, just much more of the same. And then ultimately, as I mentioned before, we're hoping to start being able to draw down on that credit facility to fund some of those deals. Organically within the portfolio, in the next sort of 18 months, we have about 6 different assets that are either in construction or we expect to commence mining. So that will take us from sort of 6 producing assets north of 10 producing assets. That's without any future acquisitions. That's just based on how these assets are maturing within our portfolio. So, that news flow, I think, will be quite material because that's, I guess, the assets within the portfolio maturing and investors can point to that cash flow. And so hopefully that should start to remove some of that valuation disconnect. So those are some of the key catalysts coming up in coming months, I'd say.
Okay. And for you, in terms of whether it be personal challenges or challenges for the board, again, coming back to the growth component, small market, starting to get noticed, great stuff. Still quite competitive out there in terms of picking up additional assets for the portfolio. How is business out there? It seems every time people talk to royalty companies, they talk about the M&A, impending M&A. It's the only way to grow. How are you scanning the horizon, and what are you seeing is happening out there? Because a lot of people are competing for the same dollars, it seems.
Yeah, so I'd say the royalty industry is fiercely competitive. If you don't have an edge, frankly. So if you're sitting back in your boardroom waiting to be fed deals by bankers, you're paying top dollar. And candidly, almost all royalty companies are focused on revenue growth. So if you've got a cash flowing royalty, understandably, there's a lot of willing buyers. So for us, it's continuing to use our proprietary database of royalties to find uncompetitive deal flow, which is what we're staying focused on, to remove that competitive sort of bidding aspect of our acquisitions. But I think to the second part of your question, what we're seeing is people thinking more and more about corporate M&A. So just last week's announcement around Deterra Royalties in Australia acquiring Trident Royalties, for their portfolio of 21 assets. I think that's an acknowledgement that, it's challenging just going out and buying 21 individual assets, but versus just buying a company that has a royalty company that has 21 assets. So we are seeing more interest and discussion between royalty companies. I think those that have, healthy pipelines of deals are probably sticking more, internally focused, like us. But then there's others that, have been beaten out of numerous auctions, and I think they're starting to more vigorously knock on other companies' doors. So we would sort of internally expect a little bit more corporate M&A over the course of this year, particularly because of those competitive dynamics that you mentioned, Matt.
Okay. And just finally, your thoughts on the kind of gold market, because predominantly what you do, I get there's a little bit of copper, maybe rare earths in there, but gold market at the moment has obviously had a fantastic start to the year. It's kind of settled back a little bit at 2,300 or so. That's great news for producers. There's a lot more margin to be had, hopefully, and it may even make some projects which perhaps would have struggled at around 2,000 viable. So knock-on effect for you obviously is very, very positive indeed. Is this the new higher low that people have been talking about? Is there still room to grow this year? What can we expect?
Yeah, I mean, we're sort of price takers, and our crystal ball for gold price forecasting is probably, it's not any better than anyone else's. But I guess what we're seeing and hearing in the market, we have the benefit of speaking to, gold producers that operate our properties on a regular basis, and obviously being heavily US centric as a company, we're obviously quite involved in how the macro is evolving there as well. central bank buying, the trend is still very much in the right direction there. And, I think that's going to continue to sort of support sort of gold, underwrite the gold price for some time. I think US election, I don't think there's been a more sort of nervously anticipated US election for some time. So as we approach November, I'm sure the gold price is going to be, receive even more of a bid around the election. The other thing I would point to is this: if you look at, because 70% of our portfolio is Australian weighted, the gold price in Aussie dollars is hovering between $3,600 and $3,700 an ounce. So, not to be flippant about it, but if you're producing any gold, or if basically you can spell the word gold in Western Australia, chances are you're making free cash flow right now. So not only are we in a fertile gold price environment, but in Aussie dollar, related terms, it's just capital is abundant to explore, develop, and expand gold mines in Western Australia right now. So, and labor's been the bottleneck, but with nickel price and some nickel mine closures, and lithium wobbling a little bit, there has been some labor that's come back into the market, and a large part of that has gone into gold operations in the local market. So, I think macro-wise and gold price-wise, we remain pretty optimistic about how the rest of this year is going to play out, Matt.
Spencer, great to speak to you as always. Keep doing what you're doing. We like it. See you soon.
Thanks so much, Matt.